Welcome to the Deep Dive, your guide to cutting through the noise and really understanding the forces shaping our world. Today, we're doing an end-of-day deep dive into the financial landscape for July 31st, 2025. And it was quite a day, anything but ordinary. If you were looking at the headlines, maybe trying to piece together why some parts of the market were just soaring, hitting new highs, while others seemed to be, well, really struggling, you're definitely in the right place. Our mission today is simple. Unpack those market moves, dig into the underlying forces driving them, and really importantly, give you those crucial nuggets of insight. Help you understand what it all means for you. We know you're navigating this constant barrage of info earnings, policy stuff, economic data. It can feel, overwhelming. So consider this your shortcut to clarity. We're distilling the essentials from, a whole stack of sources, trying to turn that complexity into something understandable.
It's true. Today really was a study in contrast, a fascinating one. The market on this Thursday wasn't just volatile. It was, I'd say, fundamentally divergent. What we saw was this perplexing split. You had certain segments just experiencing unprecedented growth, really fueled by these powerful forward-looking narratives. And then at the exact same time, other parts were under immense pressure, kind of caught between shifting economic realities and, frankly, some significant political headwinds. This divergence, it's not just, an interesting data point. It hints at a much deeper story happening beneath those headline numbers. It's a snapshot that really demands a closer look, doesn't it? To understand not just what happened, but why it matters and what it could signal for the road ahead.
Absolutely. And that divergence was right there from the start, wasn't it? Pretty apparent. Let's jump straight into that initial overview, the U.S. stock market, July 31st. If we had to give an executive summary, and it kind of boils down to this, right? A powerful, almost singular AI-driven rally, really concentrated in those mega-cap tech stocks. But like you said, it wasn't happening in a vacuum. It was running headlong into this, formidable wall of worry. And that wall, based on our sources, seems built from geopolitical trade actions, stubborn inflation that just won't quit, and the ever-present sort of hawkish shadow of the Federal Reserve. So with that collision of forces, what was the immediate result we saw in the main indices?
Well, the immediate outcome was exactly that, a market with a split personality. Traders often call it a tale of two tapes. On one side, you had the NASDAQ Composite, which, is heavily tech-focused just by its nature. It was the undisputed leader today. It surged pretty impressively 1.3% during the session, closed at a brand new all-time record, 21,396.04. And this climb, it was almost entirely lifted by really stellar, better-than-expected earnings from its biggest players, particularly Microsoft and Meta, who've both made these huge market-moving bets on AI.
Okay, so NASDAQ hitting records. Sounds like pure bullish momentum there. But that's only half the picture, isn't it? What about the broader market, the indices that are supposed to give us a more complete view of the U.S. economy?
That's exactly where the story gets, more complicated, and maybe a bit concerning for some analysts. The S&P 500, which is often seen as the best overall barometer for the U.S. equity market, it represents a much broader slice of the economy. It actually pulled back. It finished the day down 0.2%, closing at 6,388.64. And what's really notable here, what warrants attention, is that this was its third straight day of losses. This pullback came right after this frankly, remarkable six-day streak where the S&P had been setting record highs after record highs. So that powerful momentum it had clearly stalled. A reversal was happening.
And then the Dow Jones Industrial Average, the one we often look to for that traditional industrial strength. How did it handle this environment?
The Dow, comprised of those 30 large established U.S. companies more reflective of traditional industrial and maybe value sectors. It was the distinct laggard today. It fell more significantly, down 0.5%, closing at 44,584.16. And what's interesting here is despite all the market buzz lately, the Dow is still sitting about 1% below its all-time high, which it hit way back in December 2024. So it suggests that broader recovery we're seeing in tech, it just isn't filtering through to the more traditional parts of the economy that the Dow represents. And if you peel back another layer, look even deeper at the market internals. Smaller companies, like those in the Russell 2000 index, sentiment was even weaker there. The Russell 2000, tracking small cap stocks, it was trading down 0.5% before the market even opened. That pre-market weakness in smaller, more domestically focused firms was a clear sign right from the get-go that any optimism today wasn't broad-based at all. It was highly concentrated. This divergence, large cap tech versus everything else, it immediately brings to mind a really key market concept.
Right. That makes me think of what we often discuss, the generals leading, soldiers retreating dynamic. Was that what we saw today? And maybe explain that for someone hearing it for the first time.
Absolutely. You nailed it. That was the defining dynamic of the day. And it's a really crucial concept for any investor to grasp. The phrase generals leading, soldiers retreating, it vividly paints this picture of a market where just a handful of very large, influential stocks, the generals, are doing exceptionally well. They're driving the main indices higher. In this case, that was the Nasdaq, right? Heavily weighted by Microsoft, Meta, and a few others. They're the powerful ones dictating the direction of the overall market averages. But underneath that surface, the vast majority of other stocks, the soldiers, are actually struggling, losing ground, performing poorly. Today, that was exactly it. The strong headline number for the Nasdaq, driven, like I said, almost exclusively by a few giants, it masks significant underlying weakness across the wider market. We saw market breadth being decidedly negative. To put a number on it, our data showed that roughly 70% of all stocks in the S&P 500 were actually losing ground during the session. Just think about that. The S&P 500 index was down only slightly, but nearly 3/4 of the companies in it were in the red. And this dynamic, where a few mega caps pull an index up while most stocks fall, it's often seen by seasoned analysts as, well, a pretty significant cautionary signal. It suggests a potentially fragile rally, one that's narrowly supported. What it really means is the market strength isn't coming from some healthy, broad economic upswing or optimism across many industries. Instead, it's stemming from these really concentrated bets on just a few massive players. And if something were to go wrong for those generals, the whole rally could unravel pretty quickly because there's no widespread underlying strength to cushion the fall. It's like, a small elite unit winning a battle while the rest of the army is struggling. Makes you question the sustainability of the whole campaign, right?
And the S&P 500's performance, closing lower for the third day straight. That really highlights the fragility you're talking about, doesn't it? Even though it has some of those generals in its own ranks.
Precisely. And this is a critical point. For the S&P 500 to close lower 3 days running, despite the powerful tailwind from huge gains in some of its most heavily weighted components like Microsoft and Meta, who are also big in the S&P 500, well, that tells you the selling pressure in other sectors was truly substantial. Overwhelming even. It implies that the positive buzz from these tech giants just wasn't enough to overcome the widespread weakness elsewhere. The failure of the S&P 500 to rally on what should have been, really positive news from market leaders, it suggests that the combined weight of macroeconomic and political headwinds is starting to overpower that bullish earnings story. It hints that the market's path of least resistance might actually be shifting. Instead of just automatically going higher on good news from a select few, the broader market seems more susceptible now to negative forces. That could signal a tougher environment ahead for the wider equity market. It's subtle, maybe, but a significant shift in investor thinking and market mechanics.
Okay, so a really stark picture emerging. A supercharged tech sector, almost in its own orbit, driven by AI potential, while the rest of the market is grappling with a totally different set of pressures. That sets us up perfectly for the next part, digging into the day's key drivers. We identified 3 primary and often conflicting forces shaping today's trading. Spectacular corporate earnings, especially from tech, a barrage of market-moving policy edicts from the White House, and economic data that just reinforced the Fed's cautious stance. Let's kick off with what was arguably the main engine of positive momentum today. We're calling the AI earnings bonanza. This was all about truly exceptional tech earnings, especially from companies really doubling down on AI.
Indeed, the tech titans really did defy gravity today. They delivered results that didn't just beat expectations, they also spun this clear narrative for future growth. Microsoft, for example. Its shares surged dramatically after reporting fiscal Q4 results that just decisively beat analyst forecasts across the board. That rally was so strong, it briefly pushed Microsoft's market cap past the incredible $4 trillion mark, only the second company ever to hit that milestone. The stock climbed, I think, as much as 8% in early trading. What fueled it? A remarkable 27% year-over-year growth in its intelligent cloud segment. And that was powered by a staggering 39% surge in revenue from its Azure cloud unit. This wasn't just good growth, it was explosive and clearly tied to their AI investments.
And Meta Platforms was right there too, wasn't it? Kind of echoing that same AI success story.
Absolutely. Meta, the parent of Facebook, Instagram, WhatsApp, its shares jumped over 12% today, hit an all-time high, riding a very similar wave of AI-fueled optimism. They announced quarterly profits of, get this, $18.3 billion and gave a Q3 revenue forecast that was well above what analysts were expecting. And crucially, management explicitly credited their big investments in AI for making their core advertising business more efficient and perform better. Ad revenue climbed a very healthy 21%. They talked about how AI algorithms were improving ad targeting, driving more engagement, and boosting the bottom line. It wasn't just abstract AI talk. They linked it directly to real revenue-generating results, validating their strategy.
So these tech giants doing incredibly well because of their AI plays.
Did that success ripple out? Did it affect the wider tech ecosystem, especially the companies supplying the building blocks for this AI revolution?
It certainly did. And this is where you really see the interconnectedness of the whole AI ecosystem. The impressive strength from Microsoft and Meta definitely had a positive knock-on effect for the chip makers. They're essentially the foundational suppliers for this whole AI build-out. Shares at NVIDIA, for instance, a company right at the forefront of AI chip tech, gained over 1%. Advanced Micro Devices, AMD, a strong competitor, rose 2.5%. Investors were clearly pricing in the likelihood of heavier, sustained demand for AI-related hardware. They figure if these big players are doing so well with AI and committing to spend more, they're going to need way more chips, more advanced infrastructure, more data center capacity, creating the strong tailwind for the whole supply chain.
This is where it gets really interesting, beyond just one good quarter. You mentioned an AI capital expenditure arms race in our outline. Can you unpack that? What does that actually mean, and why is it so significant right now?
Yeah, this is maybe the most crucial secondary theme that came out of those earnings calls. It provides this really powerful forward-looking signal for the whole market. Beyond just the impressive headline numbers, both Microsoft and Meta confirmed they're accelerating what we can accurately call an AI capital expenditure arms race. And that's not just a catchy phrase, it's a strategic imperative for them. Both companies signaled they intend to significantly ramp up spending in the coming year, not just a little bit often in multi-billion-dollar chunks. We're not talking about buying a few more servers here. They're talking about a fundamental re-engineering and massive expansion of their entire tech infrastructure. I mean, think about it. They're committing unprecedented resources to build out what they need. Massive new data centers designed specifically for AI, acquiring more powerful specialized AI servers, securing enormous quantities of those high-end AI chips from NVIDIA, AMD, and others. This is all to support their big AI ambitions, which they clearly see as the next frontier for growth and, competitive advantage. The term arms race isn't really an exaggeration. It reflects this intense pressure to get that first mover advantage, attract the best AI talent, and deliver cutting-edge AI products before their rivals do. And this commitment to spending, it's a powerful forward-looking indicator for the entire AI supply chain. It confirms this durable, multi-year investment cycle that provides a clear demand tailwind for semiconductor firms, data center operators, equipment manufacturers, the whole lot. It transforms these earnings reports from just looking back at past success into a credible signal of future significant revenue for an entire ecosystem of related companies. It tells us the AI trend isn't fleeting. It's foundational, transformative shift that's going to require monumental investment across tech for years to come. For investors, it means looking beyond just the next quarter and understanding these multi-year capital spending plans that are now essentially locked in.
That's a powerful, incredibly bullish story for one corner of the market. Now, let's pivot sharply. Let's talk about the contrasting force today. Those trade and regulatory actions from the Trump administration, they seem to be the main source of negativity and volatility for, well, pretty much the rest of the market. Tell us about these policy edicts.
Yes. While tech was soaring, the White House was definitely active on several other fronts, sending distinct shockwaves through different, often more traditional sectors. First big one, a direct pharmaceutical ultimatum. The White House sent these strongly worded letters to major drug companies, including some of the biggest names, demanding they present actionable plans to cut drug prices within a really aggressive 60-day time frame. This direct political pressure, basically signaling potential government intervention in pricing, it triggered an immediate, noticeable sell-off right across the healthcare sector, particularly pharma companies and managed care providers. We saw Eli Lilly fall 2%, United Health slid 4.9%, Bristol Myers Squibb dropped 4.5%. It was swift, noticeable, and a very direct reaction to a policy threat that just fundamentally changes the perceived profitability and stability of what's usually seen as a defensive sector.
And it wasn't just pharma, right? It seemed like there was also a big structural change affecting how certain imports are handled, impacting a totally different part of the economy.
Exactly. And this change had a much broader reach than just one industry. President Trump signed an executive order suspending the de minimis tariff exemption. Just to clarify for listeners, this rule previously allowed individual shipments valued at $800 or less to enter the U.S. duty-free. No tariffs, less customs hassle. It was originally meant to streamline things for low-value goods, but in recent years, it had been heavily used, some would say exploited, by e-commerce giants and foreign manufacturers to ship goods directly to U.S. consumers from overseas without paying the duties that traditional importers face. So this policy change, it's a structural blow to the business models of many e-commerce and logistics firms that rely heavily on this for cheap imports. Think fast fashion retailers, sellers of small gadgets, even artisans sourcing components internationally. And just to give you a sense of the scale here, the volume of these de minimis shipments, it grew exponentially from about 134 million back in 2015 to over 1.36 billion with a B in 2024. That's a truly massive increase. And now that avenue for cheaper, duty-free imports is basically closed off. This forces a fundamental rethink for countless businesses. It could mean higher costs for them, maybe passed on to consumers, impacting prices on a whole range of imported stuff that used to be too small to tax. It's a significant shift in trade policy that touches everyday commerce.
And it seems the administration wasn't stopping there. We also saw a flurry of international trade actions and threats, adding a lot of uncertainty on multiple global fronts.
Indeed, it really felt like a multi-front offensive on commerce today. We saw a new trade agreement finalized with South Korea, but critically, it included a new 15% tariff on specific Korean imports. At the same time, the administration announced a much more painful 25% tariff on a broad range of imports from India. The stated reason was frustration with India's trade practices, which the U.S. sees as unfair, and also its continued purchases of Russian energy, undermining sanctions. That punitive tariff specifically sent Indian markets tumbling, showing the direct economic pain these things can inflict. Then, in a kind of surprise move that really rattled commodity markets, a 50% levy was announced on certain copper products. This caught the market off guard and immediately caused U.S. copper futures to plunge, I think by as much as 22% at one point during trading. That had knock-on effects for mining stocks, industrial companies using copper. So yeah, it was a real barrage of highly targeted actions, each with its own reason and immediate market impact.
So these aren't just isolated things then. What's the broader significance here? Is this signaling a fundamental shift in U.S. trade policy, and how should investors be thinking about this?
These actions definitely show a significant evolution in U.S. trade policy. We're moving beyond maybe the broad rhetoric or general threats we saw in the past. The current administration's moves seem to be highly targeted strikes aimed at specific industries, specific countries, even specific products. And this approach fundamentally changes the risk landscape for investors. It forces them to price in this new, unpredictable political intervention risk on a sector-by-sector, maybe even company-by-company basis. For example, sectors traditionally seen as stable, defensive, like healthcare. Because demand is consistent, they seem insulated from economic cycles. Well, now they're suddenly vulnerable to these abrupt, politically driven shocks. This makes long-term planning way more complex for companies in the crosshairs. Their profitability can be instantly reshaped by an executive order or a new tariff. For investors, it means fundamental analysis now has to include a much heavier weighting on geopolitical risk and policy uncertainty. Those old assumptions about predictable trade flows, stable regulations, they're being challenged. It creates a more volatile, less certain investment climate outside of that high-flying tech sector.
Okay, so we've dissected the soaring tech sector fueled by AI, and then these impactful targeted trade and regulatory actions creating major headwinds elsewhere. Now, let's turn to the economic data. What did today's numbers tell us? And what does it all mean for the Federal Reserve and that whole interest rate debate?
Right. The economic data released today painted a very clear picture. A resilient U.S. economy, yes, but one where these persistent inflationary pressures are giving the Fed very little room, if any, to ease up on policy. Specifically, we got the June Personal Consumption Expenditures, or PCE, price index, and it's crucial for listeners to remember PCE is the Fed's preferred inflation gauge. Not the CPI, which gets more headlines maybe, but PCE. It measures a broader range of goods and services, and it accounts for how consumers might switch spending if prices rise too much. So the Fed sees it as a more comprehensive, accurate picture of underlying inflation. And that PCE index, it rose to plus 2.6% year over year in June. That's its highest reading of 2025, and it was 10 basis points above what economists expected. Even more telling, maybe, is the core PCE index that strips out volatile food and energy prices to get at underlying trends. It held steady at an upwardly revised plus 2.8%. That's its highest level since February. So the message from this data is pretty unambiguous. Inflation is clearly not cooling as fast as the Fed or the market had hoped. It suggests the disinflation trend has maybe stalled or even slightly reversed.
And the labor market is still showing incredible strength too, right? That's another piece that always factors into the Fed's thinking.
Very much so. The labor market continues to look robust, reinforcing that resilient economy narrative. Initial jobless claims new unemployment filings, they stayed remarkably low at 218,000. That's well below any level that would signal significant job market weakness. And continuing claims people already getting unemployment benefits, they also held steady at 1.946 million. These numbers together suggest employers are still holding on to workers, not seeing a big spike in layoffs. That indicates continued tightness in the labor market, which, is good for workers, but it can also contribute to wage inflation and make the Fed's job even harder.
So how did this combination of data, especially those sticky inflation numbers, affect what the market expects the Fed to do with interest rates? Any shift in rate cut odds?
Oh, the impact was immediate and dramatic. You had Fed Chair Powell's cautious press conference on Wednesday giving little hope for an imminent pivot. Then you layer on Thursday's hotter-than-expected inflation data. It sent a really clear message to bond traders and investors. They drastically scaled back their bets on a September interest rate cut. According to the CME Group's data, tracking futures probabilities, the chance of a cut at the September meeting, it's fallen to just 39%. That's a sharp drop from 58.4% just a week ago, and a really steep fall from 75.4% a month ago. So the market is quickly adjusting to the idea that rate cuts might be further off than hoped, pushing out that timeline for potential easing. In the bond market, Treasury yields held relatively steady despite all this. The benchmark 10-year slipped just slightly to 4.36%. That suggests maybe much of the Fed's stance was already priced in, but today's data certainly confirmed that higher-for-longer outlook.
This brings us back to a concept we've touched on before, and it seems totally relevant right now. The good news is bad news paradox. Can you walk us through how that's playing out? It seems counterintuitive, right?
Yeah.
Celebrating strong economic news, but then fearing its consequences.
This paradox is absolutely critical to understanding the market's current dilemma. It often trips up new investors, so let's break it down. On one hand, you have data showing a strong labor market, rebounding GDP, rising incomes, all things we've been seeing. That paints a positive picture of the U.S. economy's fundamental health. From a purely economic view, you'd think strong data is always good for stocks, right? Signals a robust environment for corporate profits. That's the good news. However, in the current inflationary environment, that very same economic strength is a primary driver of the persistent inflation we just saw in the PCE report. A strong economy means strong demand, which can push prices higher. And because the Fed's #1 job right now is controlling inflation, getting it back to their 2% target, this strong data gives them every reason to keep their foot on the brake. To maintain that hawkish higher-for-longer interest rate policy, it means they'll likely keep rates high for longer to cool demand and tame inflation, even if it slows the economy a bit. That's the bad news for the market. So the market's basically caught in this push-pull. It's trying to celebrate the underlying economic resilience, which is fundamentally good for long-term profits. But at the same time, it's fearing the restrictive monetary policy that resilience brings. Good economic news, like strong jobs, paradoxically pushes out the timeline for rate cuts, which many investors believe are needed to fuel the next broad market rally. It creates the situation where normally positive economic signs are read as negative for near-term stock performance, leads to volatility, confusion. It's a delicate balance, and the market's constantly trying to guess the Fed's next move based on the latest data point.
Okay, so we've seen the broad indices telling a story of divergence, tech having its own AI narrative, Washington's policies creating headwinds, and economic data keeping the Fed cautious. Now let's look even closer, really get under the hood of the market, beyond those major indices. This is where it gets incredibly detailed, right? Looking at how individual stocks and whole sectors reacted to all these powerful, often conflicting forces.
Yeah, a closer look at the market internals really throws the day's extreme divergence into sharp relief. At the individual stock and sector level, we saw some truly massive moves both up and down, largely driven by earnings reports, which can either launch a stock or crater it, and of course, that policy news we just talked about.
Let's talk about some of those top movers then. Who really stood out today with those outsized gains?
On the upside, we saw some names, maybe not household names like the tech giants, but it's really exploded. Newegg Commerce, ticker NAGI, surged over 40%. 40.38%. American Superconductor Corp, AMSC, gained an impressive 31.45%, and Impinj, PI, was up 27.69%. These companies saw their shares rally sharply, mostly due to strong, unexpected earnings that seemed to resonate with that broader tech and AI momentum, suggesting specific company success stories within those bigger trends. And then, a more widely recognized name, eBay, soared 17.91%. That came after the e-commerce firm reported better than expected quarterly results, showing some resilience in online retail. Crucially, they also gave a strong forward outlook, driven by a healthy 6% rise in gross merchandise volume, suggests renewed consumer spending on their platform. So even outside mega-cap tech, strong earnings and positive guidance were met with really enthusiastic buying. Highlights that even if breadth was narrow, there were still big opportunities based on strong company fundamentals.
And the flip side of that coin, In a market with such strong headwinds in places, who really got hit hard today, who saw significant losses?
Oof. The day's biggest decliner by a really wide margin was Align Technology, ALGN, maker of Invisalign clear aligners. It plummeted a staggering 37.10%. 37%. That came after its Q2 results missed analysts' expectations on both revenue and earnings per share, signaled a big slowdown in their core business, and to make matters worse for investors, the company also announced a major corporate restructuring. That'll include widespread layoffs and incur one-time charges up to $170 million in the second half. So that double whammy financial miss plus painful restructuring just sent investors running for the exits. Other companies seeing substantial drops included Confluent, CFLT, a data streaming platform, down 33.18%, and Baxter International, BAX, a healthcare company, down 22.10%. Both of those also faced severe sell-offs due to disappointing results, or, in Baxter's case, significantly weaker forward guidance. It just shows you, in this kind of market with so much uncertainty, the penalty for missing expectations or signaling future weakness, it can be absolutely brutal. Immediate, dramatic value destruction for shareholders.
So, individual stocks showing extremes. But the performance of the 11 S&P 500 sectors, that must provide the clearest sort of overarching picture of this divided market, right? Tells us where the money was really flowing or maybe fleeing from.
It absolutely does. The sector performance is almost a perfect visual of that tale of two tapes. The communication services sector, which includes Meta, surged an impressive 3.1% today. And the information technology sector, home to Microsoft and NVIDIA, was up a solid 1.2%. Both of these sectors, driven by their biggest components' stellar earnings, actually hit record highs during the session. Their outperformance was almost entirely down to those powerful rallies in Meta and Microsoft as their AI strategies really paid off. Looking at the whole month of July, Infotech was the top performer, gaining 5%. Interestingly, the defensive utility sector also did well for the month, also gaining 5%, maybe signaling a bit of a flight to safety in some corners.
And at the other end, which sectors really bore the brunt of the selling pressure today, showing the impact of those macro and policy headwinds?
At the other extreme, the healthcare sector was by far the biggest drag on the market today, declined sharply by 2.5%. This was, like we discussed, a direct and immediate reaction to that White House ultimatum on drug pricing. It actually finished as the worst performing sector for the entire month of July, losing 1%. A really clear reflection of how quickly political risk can just reshape an industry's outlook. Other significant laggards today included materials, down 2.0%, likely reacting to that surprise 50% tariff on copper. And energy, down 1.4%, maybe due to global demand concerns reflected in trade actions or just broader caution on commodities. It's a stark illustration. Targeted policy can immediately hammer specific industries, overriding whatever broader market sentiment exists and just fundamentally changing their risk profile.
Now, this wasn't just a U.S. story today, was it?
Okay.
Given the trade actions, the broader economic currents.
Yeah.
How did the rest of the world react? Were global markets echoing the same divisions, or did they have their own distinct things going on?
You're absolutely right. The global markets definitely had their own dynamics, though often influenced directly or indirectly by what was happening in the U.S. European markets, for instance, closed, mixed to slightly higher. London's FTSE 100 was mostly flat. Frankfurt's DAX rose 0.2%. Paris's CAC 40 gained 0.1%. Their sessions were generally supported by some upbeat earnings reports from European companies, showing some resilience there. But those gains were noticeably capped by worries over the U.S. tariffs. Specifically hit European mining stocks after that sharp drop in copper prices. Shows how quickly U.S. policy can ripple across continents, even hitting sectors not directly targeted. So even across the Atlantic, the White House's actions were felt, adding a cautious tone.
And what about Asia? That region's often very sensitive to trade news, global economic signals.
Asia was mostly lower today, with one significant exception. Japan's Nikkei 225 actually rallied a healthy 1.0%, closing at 41,069.82. That positive move came after the Bank of Japan held its key interest rate steady, providing some stability, but importantly, also raised its inflation forecast for the year. That seemed to reassure investors the economy was firming up, a more optimistic domestic outlook there. But in stark contrast, Chinese markets are noticeably pressured. They reacted negatively to a weaker than expected official manufacturing PMI. That's a key indicator, and it fell further into contraction territory at 49.3. Signaled a slowdown in China's vital manufacturing sector. That sparked renewed worries about the health of the world's second largest economy. So the Shanghai Composite fell 1.2%, Hong Kong's Hang Seng dropped 1.6%, and then in India, the BSE Sensex fell 0.36%, specifically reacting to that direct threat of the 25% U.S. tariffs we talked about. So yeah, Asia, a very mixed picture, driven largely by local economic data and those direct, palpable impacts from U.S. trade policy.
Okay, so we start to wrap up this deep dive into the pretty complex market dynamics of July 31st. All eyes are already looking ahead. What's on the immediate horizon for August 1st that could really shift these dynamics, potentially decide the market's direction for the end of the week?
Yeah, heading into Friday, the market's really poised at a critical inflection point. We've got major catalysts coming both after today's close and before tomorrow's open. The immediate focus for investors tonight, undoubtedly the after-hours earnings from the remaining Magnificent Seven giants. Apple and Amazon, these aren't just any companies, right? Their performance, their outlook, they're bellwethers for consumer spending, cloud computing, the whole tech industry. For Apple, the market's going to be scrutinizing sales growth figures really closely, especially iPhone, services, those key revenue drivers. But maybe even more importantly, investors will be looking for any new details, any increased investment plans related to its new Apple Intelligence initiatives, how they talk about their AI strategy, the scale of their planned spending, any tangible AI-driven products that could significantly move the stock and maybe set the tone for all of tech going into Friday. And for Amazon, the paramount focus will be on Amazon Web Services, AWS, its cloud division. AWS is Amazon's profit engine. Its growth rate is seen as a key indicator for enterprise spending on cloud infrastructure, which also ties back into that broader AI build-out. Its overall revenue growth, especially e-commerce, will also be watched closely for signs of consumer health. So the results and guidance from these two behemoths, commanding trillions in market cap, they'll largely determine if this tech-led rally has enough steam left to carry through the week, or if we see some profit-taking.
And beyond those tech giants, what's the single most significant economic event for Friday? The one everyone will be watching. Feels like the jobs report often holds a unique sway over the Fed.
You're absolutely right. That would undoubtedly be the release of the July non-farm payrolls report. This is truly the most significant scheduled economic event for Friday, offers a crucial, comprehensive read on U.S. labor market health, the consensus forecast among economists. For a headline addition of about plus 105,000 jobs, that reflects a cooling but still pretty solid jobs market. Now, this report could be a real game changer, the ultimate arbiter of market direction tomorrow. You've got two main scenarios with totally different market implications. If we see a much stronger number than expected, say, well over 150,000 jobs, it would likely reinforce that strong economy hawkish Fed narrative we talked about. That would further diminish rate cut hopes, push expectations out even further, and could potentially press equities lower across the board as that good news is bad news paradox plays out powerfully. Conversely, if we get a significantly weaker number, maybe below 80,000 jobs, maybe even negative, that could reignite hopes for a September rate cut. That kind of reading would suggest the labor market is finally showing real signs of softening, maybe giving the Fed the justification it needs to consider easing policy. That scenario could possibly spark a more broad-based market rally as investors price in cheaper borrowing costs down the line. Other key things in the report to watch. The unemployment rate was 4.1%, and crucially, average hourly earnings, a direct measure of wage inflation. Any acceleration there would be a red flag for the Fed.
And any other earnings reports on tap for Friday that could matter for specific sectors or give broader economic clues?
Yes, also on the schedule for Friday are earnings from the energy supermajors, ExxonMobil and Chevron. Their results will give key insights not just into the health of the energy sector, which has faced some headwinds, but also broader signals about global economic demand given their exposure to oil and gas prices. Their comments on spending plans and commodity outlook will be watched closely too. So yeah, in summary, the market's poised for an exceptionally volatile end to the week. That fundamental tension between the narrow AI-fueled tech rally and the broader macro headwinds, persistent inflation, cautious Fed that tension will likely get resolved by the incoming jobs data. While Apple and Amazon's after-hours performance will certainly set the initial tone for tech sentiment, the jobs report will ultimately be the decisive factor for overall market direction. Strong report. Could see the broader market sell off as rate hopes fade. Weak report. Might provide the catalyst for a more inclusive risk-on rally to close the week. It's going to be absolutely fascinating to watch unfold.
What a day. Truly marked by so many powerful, often conflicting forces all swirling around. We've really seen that incredible resilience, maybe even exuberance, of big tech and its AI momentum, almost operating in its own little economic bubble. And that stands in such sharp contrast, doesn't it, with the broad market struggle against that sticky inflation, the Fed's cautious stance, and those unpredictable policy shifts coming out of Washington. Really highlights how segmented and complex the market can get, with different parts reacting to completely different things.
Which brings us, I think, to a really important question for you, our listener, as you learn and observe these huge, rapidly shifting economic landscapes. Given this growing divergence we've talked about today, a few powerful companies driving so much of the market's gains, while other sectors face these direct political and economic headwinds that can just change in an instant, how might traditional investment strategies need to adapt to this new, maybe more bifurcated landscape? When macroeconomic policy and geopolitical shifts can so swiftly reshape entire sectors, what does that mean for diversification, for sector allocation, even for how you evaluate risk and opportunity? It's something truly worth considering, I think, as you look forward and process the information from days like today.
That's a profound thought to sit with and definitely resonates with the kind of insights we aim to bring you here. Thank you so much for joining us on this deep dive today. We hope you're leaving with a much clearer picture of today's market and maybe, a few new, compelling questions to explore on your own. Until next time, keep digging into what fascinates you and stay well informed.